US politics is weighing on US yields and the US dollar. What was known as a so-called Trump trade last year has transformed into its opposite. The US dollar is now trading 5% below levels prevailing before last year's US elections. Since mid-July, political turmoil in Washington has grown consistently. High-ranking officials have resigned or were dismissed, and business leaders have turned their back on Trump after his controversial response to the right-wing violence in Charlottesville. Over the next weeks, matters may get worse. The US Congress needs to raise the US debt ceiling and agree on a new budget by the end of September. Otherwise, a government shutdown and, worse, even a technical default looms. Politically volatile September weeks are ahead, but a last-minute deal is still likely in our view. This may be followed by some progress on the tax reform, given mounting pressures on Republican congressmen to deliver on key election promises in order to avoid electoral punishment in next year's midterms. So US politics will continue to weigh on US yields and the dollar in September, but the outlook is about to brighten once the debt ceiling hurdle is cleared. Receding US inflation rates have raised doubts among investors that the Fed will deliver on any further rate hikes. Markets attach only the odds of a coin toss that the Fed will hike its key rate once more over the next 12 months. We deem these doubts overdone. The US economy will continue to grow decently, unemployment will drop further. Inflation will undershoot the Fed's 2% target for somewhat longer, but we expect the tight US labor market to translate into more visible price pressures in 2018. Furthermore, despite 3 rate hikes since December last year, US financial conditions have continued to ease, thanks to lower bond yields, rising equities and tighter spreads on corporate bonds. At its meeting on September 19 and 20, the Fed will most likely forgo a rate hike, but will announce the start of a gradual reduction of its $4.5 trillion balance sheet. The Fed may then decide to remain on hold in December, which is a close call though. Going into 2018, however, markets are much too sanguine about the speed of further rate normalization in the US. We expect the Fed to deliver another 3 rate hikes then. This would leave rates at close to 2% by end 2018, about 50 basis points higher than currently discounted by markets. After rallying by 13% this year, the euro-dollar looks prone for a moderate correction by year-end. Up until mid-July, the rise in the euro-dollar was attributable to tighter yield differentials between the US and the euro area. The yields on 10-year US bonds are down by almost 30 basis points year-to-date, those on bunds up by more than 15 basis points. Since mid-July, however, intensifying political turmoil in the US administration has increased the political risk premium on the US dollar to about 5%. This is reflected in a widening gap between the euro-dollar and levels implied by other financial market variables, as shown in the grey line in the chart. Political brinkmanship over the coming weeks will continue to weigh on the greenback. A last-minute deal in the US Congress on the US debt ceiling by the end of September, however, would brighten the outlook for the dollar. Conversely, any further euro strength will likely run into verbal intervention by the ECB. So the euro-dollar seems headed for a moderate correction by year-end rather than an extended rally. A more protected dollar recovery, however, is not on the card. Going into 2018, we anticipate moderate tailwinds to the euro to prevail again, helped by the ECB's tapering of its asset purchases and the euro area's high current account surplus. Thank you very much for your attention. We will keep you posted.